You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome back to The Builder's Mindset. For any of you who remember the show The Wire, which is arguably one of the best television shows ever created, in my opinion, famous quote in there: you follow the drugs, you're going to find drug addicts and drug dealers. You follow the money, you don't know where the F it's going to lead you. Lester Freeman. Always appreciated Lester Freeman and his character in The Wire. For those of you who remember, he's a quiet, methodical guy. He made those little models and whatnot, but he was just really good about following the details. And most of what he did was the research and the back stuff. He did the field work sometimes, but man, I thought about that quote today as I was thinking about today's episode. And everywhere you turn right now, the headlines say housing is in crisis. Negative headlines everywhere here and there. Affordability is dead. Interest rates killing demand, and the building industry is doomed. Well, here's the thing. If you zoom in on some of the smarter operators, the story can look a lot different than what the headlines tell. And to be quite honest, we often point out that the headlines aren't all they're cracked up to be. Sometimes the articles don't even match the headlines. But today I was thinking about this and I wanted to connect a couple of threads. I want to talk a little bit about what Lennar and D.R. Horton are actually doing on the ground from the reports on their earnings calls, and what Warren Buffett and Apollo are also doing with billions of dollars kind of quietly behind the scenes. If you follow the money, you never know where it's going to lead you. If you follow the money, you'll figure it out. So, because you put the two together, and the playbook for navigating this market, in my opinion, starts to get clear. And we all knew that 2025 wasn't going to be great. And I've been saying plus or minus 5% for quite some time. I still feel reasonably solid on that, probably closer to the minus 5% at this point in time. And everybody's been prepping for a rebound in 26. And I think that's part of the, what I'll call the passive inactionable optimism that is, let's pray for lower interest rates, right? That's going to solve all our problems. And, you know, I've talked about, like, you could sit around and be a boat afloat in the ocean and let the tide take you up and take you down, or you could start to operate and control the controllables. So what can you control? Let's start with these operators and talk about what stood out for us as we looked at Lennar and Horton and their recent earnings calls. The big takeaway for me was simple, and it was control what you can control. Don't whine and complain about the situation. Just adapt, don't react. So margins are down. Sure, absolutely. Okay, it's a fact. Incentives are up, big part of why margins are down. But you don't hear or really see Lennar and Horton panicking. They continue to execute. Now, those two, number one and number two, they're executing a little bit differently in terms of like what they're focused on and what their strategy is. As we all know, Horton is still a very decentralized model, really let their divisions kind of operate the way they'd like to operate. And Lennar is more, you know, I affectionately refer to them as the Death Star. You know, it's like sort of there are a lot of things that they do well as a unit, and corporate pushes down a lot of things, and it's just a different way of doing business. And for those of you who's listened to enough of my podcasts, you know that I have admiration for both those companies and what they do and how they do it. You know, Lennar's focused on a lot of things. First off, they've cut cycle time to 132 days, 12% improvement year over year. And looking at some of the other builders, they're not the best in the industry right now. You've got Century and Meritage, who are, I'd say, more along the lines of 120-ish days. So they've got room to improve there, and they're going to continue to focus on that. They continue to keep their completed unsold homes at 2 or less per community. That's their goal. Horton pushed 24% more starts in a single quarter, and more than half of their closings came from same quarter sales. So I think Horton's kind of managing their overall aging inventory, for lack of a better term, but they're also prepping up for what's to come by keeping the starts moving. And that's not like just luck and throwing stuff at the wall to see what sticks and see what figures out. That's discipline. And if you listen to the earnings call for both of these companies, you'd have to admit, number one, that they're both doing different things in how they're approaching. They have different strategies, but they are executing their game plan, and they're sticking to their game plan. They're not trying to control the market. They're controlling inventory, cycle times, construction costs, and land. And they're adjusting specs and incentives almost on a weekly basis. Lennar talked about, I want to say in the previous quarter, not this most recent one, but the one before, they acknowledged that they didn't react fast enough to the shifting market, and they did not keep up with the incentives to keep. Lennar's strategy, typically, if you put it in a nutshell, one sentence would typically be, they make a plan for their production starts, and then they adjust their price or MSRP to match that, whatever they need to do. And a couple quarters ago, they admitted they said we got a little behind and we didn't react fast enough. That's really their strategy. And I think I would describe Horton as a little bit more of a balanced approach of trying to balance those two. Whereas if you look at some of the other builders, say like the margin protectors, I'd say like a Tri-Point and a Pulte, they're going to take a little bit more tempered, like adjusting their production to match the sales pace with the margins they want to. Essentially, they're all doing the same thing, but when they look at sales pace and margin, they have different levels of importance between those two, in terms of, because you can lower price to maintain pace, or you can slow up pace to maintain price. And if you maintain price, you're going to, typically you're going to maintain margin. And so the real clarity in the playbook, the real playbook that they're all executing is being clear on what their plan is and executing to it, doing it quickly and efficiently to respond to maintain the control that they're trying to keep in that plan. So that's operationally what we're talking about. And those two builders and a lot of the other builders out there are saying, what's our strategy? How can we execute and control what we can control to implement our strategy the most effective way possible? The market be what it is. So let's now talk about the money, the other money. Buffett, it just came out that Buffett put a total of, what was it, 1.8, 1.6, 1.8, almost $2 billion, 1.856, something like that, in a combination of Lennar, D.R. Horton, and Nucor, America's largest steel manufacturer, which that's a topic for another podcast that we're going to do. And we got an article, just coming out about that. But essentially, they've been building positions in Lennar to the tune of $800 million, and Horton to the tune of $200 million. And then Nucor Steel, they're almost $860 million. So nearly $2 billion in fresh capital flowing into builders and America's largest steel manufacturer. And they're doing it, and the home builders in particular, not at the bottom, but while these stocks are recovering. I mean, if you watch the stocks, I'm not an analyst. I'm not going to say exactly off the top of my head when the bottom was, but they're not at their highs, but they're also not at the lows that they were at, let's say, in the last, like, say, year to date. Stocks are up, but so that is not speculation, that's conviction. He could have put that capital anywhere. Could have put in tech, energy, banks. He did make a big investment also in healthcare, but he put $1 billion between Horton and Lennar in home building. And here's the kicker. He didn't, like I said, he didn't buy it at the bottom. He's been adding to it. And that's, we all know, like, the Oracle of Wall Street, like, Buffett makes long-term bets on companies, and these stocks were already starting to recover, and he's buying them. What does that tell you? Well, it tells you, in my opinion, that he believes in home building. And look, he's saying the same thing that the operators are showing us. The industry is strong, and the long-term value is undeniable. We've been talking here about the demographic fundamentals, like the inherent demand. We're not shying away from the affordability challenges and the headwinds that's creating. We're not shying away from the aspect that, yes, there are, challenges to buyers executing on that demand. But let's go a little bit further to something we talked about a little while back. And let's also talk some more about money. And, Buffett's not always right, but he's got a darn good track record. I think there's a few politicians who apparently have a slightly better track record than him, but that's a story for another day. A little sarcasm there. But he's got a pretty good track record. But let's go back. It's not just Buffett. Apollo-backed new home company bought Lennar for $1.2 billion. We talked about this a while back. The smaller private fish bought the larger public. Number 62 ranked builder with just over 1,000 closings bought the number 33 ranked builder with nearly 3,000 to create a top 25. You don't, and from what I read, you don't write a $650 million equity check for that deal if you think the market's in collapse. You do it because you believe in the fundamentals and you see the growth. On the day that was announced and the number came out, I believe it was a 62% premium, I believe, over the stock price of Lennar at that day. You don't dump that kind of cash into a deal like that if you don't believe it. Now, so when you look at that and you go back to the operators, here's what I connect the dots on is scale, efficiency, and operations. You take the new home company with its pedigree and leadership at 1,100, I think, closings they had in 2024, and you take Lennar and their 3,000 closings, you put them together, and you make this, you go from, two number 62 and number 33, and I think it's, whether it's a top 25, I think it's going to be potentially a top 20 builder now. You start to create scale. Well, what did Lennar talk about when they said they're willing to give up margins in the short term for the long term? They talked at length about they believe continuing to maintain their volume and their systems that they've designed to maintain that volume. They said they felt they would make it up in the long run because it was harder and more cost effective to downshift that machine and then ramp it back up again. If we go back too, we talk about some of the other statistics, like look at the writing on the wall. 2023, about 50% of new home closings in the United States came from the top 20 home builders. 2024, that was about 60%. It's growing. So whether it's Buffett on Wall Street or Apollo in private equity, the people with capital are telling us the same thing as what the operators are. Housing isn't sinking. It's transitioning and transforming. On that note of transforming, Berkshire Hathaway also recently put an article. There's an article that came out talking about the demographic collision and the backdrop that makes this all the more interesting. Baby boomers are downsizing, and younger millennials and the older Gen Zs who are trying to get into the market, they're desperate to buy because the American dream is still alive and well. It's just harder to get to. institutional investors are still competing for this inventory of these smaller homes. What you would argue, I would say, is more of the entry-level sized homes. Are some of the baby boomers going to be buying smaller, nicer homes? Yes, but the smaller homes are going to be taxed from a demand perspective. The result of this is demand isn't disappearing. It's actually colliding, and it's going to create some interesting dynamics over, I would say, the next 3 to 5 years. This means the builders who win will be the ones who are fast, disciplined, and clear, confident, and consistent on their cost structure. Exactly what Lennar, Horton, and Meritage are showing us. They're focusing on this high volume consistency of delivery. If you even we'll go a little deeper into Meritage. Meritage's philosophy, if you talk to them, they'll even say they're gearing up. And this was interesting. They are gearing up to compete with the new home market, with the resale market. Why do I find that interesting? Go back to what I said. A lot of people are sitting around waiting for interest rates to come down. Here's the conundrum of interest rates coming down for the new home industry and this is why I agree with Lennar's talk about let's not downshift and then try to gear back up again. When interest rates come down, that makes resale homes more attractive again. So now, and I know there's all the talk about a new home is better, all this other reason, but what a resale home has and will continue to have that new homes don't have and probably will never have, at scale anyway, is two things. The quick close, okay? The home is existing, it's done. You're not worried about, finishing a home and trades building homes and whatnot. And two, they're in more established neighborhoods. And let's be honest, there are some people who want to live in a more established neighborhood and they want to, be closer to certain, centers and things like that. So right now, I think people are moving more towards new homes because of the incentives, because of the interest rates that they can get from home builders buying them down. And I think there are some people who are going out a little further in the suburbs than they'd like to, and they're enjoying the benefits that come along with that financially, but there are a lot of people I think who would prefer to be closer into the work centers and the town centers and whatnot. So when interest rates come down, the conundrum starts to be is how much demand does that pull away or strain does that put on the new home market back over to the resale market? So it'll be interesting to see how that pans out. But when you look at that and interest rates coming down, if you're someone like a Meritage who can hedge that bet a bit, or Lennar who's got some specs, or a Horton who's got specs, and you don't scale your inventory way back from a scarcity model, you don't have to worry so much about the competition from availability of homes. So you can still sell into, we can close you. I think the Meritage thing is they'll close you within 60 days, just like you would on a resale home. And we can buy your rate down and we'll get you in that home quick and you get a brand new home with a full warranty. So I think that's going to be interesting to see how all of that plays out. But I think here's how it all comes together. When you look at the operators on the ground, like Lennar, Horton, Meritage, and the other publics in the top 20s, they're proving that discipline and clarity can create strength in any market. All right. Yes, the margins are down, but most of the home builders in the top 20 are still at 20% gross margin or better. There's a couple that aren't, and Lennar is one of them. They have no shame in their game about that. And investors with billions like Buffett and Apollo are validating that strength by putting their capital behind it. The other thing that these large builders have too as a hedge is they can sell to some of these institutional investors who are doing build for rent, that don't want to build their own community. So they can sell phases worth of homes to go out for rent. And I think we'll see more of that. And if these entities, these big builders and the equity money believe in the long-term fundamentals of housing, then what excuse do you have? So now I'm talking to our, not top 20, our private builders mostly. We need to forget the noise and forget the fear and start playing offense. Control what you can control. Your specs, your cycle times, your cost through product development. not through beating up your trades for a lower price. Because you know what? Good luck with that when you're competing with the companies who have 60% of the capacity. Where's your leverage? Remember a story from back in the day, even new home construction. When you look at the flooring industry, most of the flooring manufacturers, the 80+% of the business for the flooring manufacturers goes through the big box retailers and their retail establishments. The new home construction market is a very, very small percentage of that industry. So same concepts apply. If I'm the 147th builder in the country and I'm doing 600 homes a year, I'm arguably going to be smaller than the two or three divisions of the divisions of the two or three largest publics in my market. Where's my leverage? You have some, but your leverage starts with your product design. Don't try to build a Porsche in a market where you're trying to sell at the price of a Mazda. It's not that people won't see your product and see the value in it, but they can't afford it. This is the market right now we're in. We have inflationary pressures coming on cost, but deflationary pressures coming on sell price. I don't think those deflationary pressures on sell price go away anytime soon. I'm not going to predict a crash, but I'm saying we're going to see those prices stabilized, and I don't see them moving in a crazy way. Even if we get 3 interest rate cuts this year, like Morgan said could happen, at best I see that as 1%, 2 quarters and a half. At worst, I see it as only 2 quarters. That's not going to move the needle in a big way. 30-year fixed rates right now, non-FHA, are 6.5% right now. I think 6 3/4. So if we pull that down, if they track with the Fed's rate, which they've historically, not been doing that quite so, linearly in the past like 5 years. But even if they do, and we go to 5.5, builders are already buying the rates down to 5, and some even lower than that. So, you've got to control your cost. Your cost of your product is the single largest component of your percentage-wise of your MSRP. Yes, control your land. Yes, control your land development costs. Control all of that. But if you don't start with your product development, you are dead in the water. DOA, dead on arrival. And then also control your people. What do I mean by that? Right now, people are moving around. This is the time and the opportunity to make strategic moves. Level up, get those key players. If you've got C players, time to trade up and get some B's and A's. Get those people that are going to help you be the better operator that you know you want to be. That's how you win in a choppy market. Do you want to survive or do you want to thrive? You can thrive in this market. You absolutely can. And you don't have to be a public home builder building even 500 homes a year to do this. You can do this on a scale of 100 to 500 homes a year. We help people do it. It all starts with product development. And you got to tie that to your land planning and entitlement. Because if your land planning and your entitlement are driving your product development, that's the tail wagging the dog. Sorry, hate to say it. You've got to look at them together. So listen, here's the truth. The headlines, they profit on panic because they get clicks. That's what they're looking for. And I hate to say it, but blood sells. I have to say blood sells. Bloody, nasty headlines sell over good news, okay? But the smart money, it profits on the fundamentals and it profits on execution. Let's stop waiting for clarity. Create it. You can make your own strategy, your own plan. Buffett and Apollo, Lennar, Horton, Meritage, some of the other ones, they're all pointing in the same direction, and it's not a coincidence. That's a roadmap. They're telling you the fundamentals for long-term are good. Start working on executing on it now, because I'm thinking that 2026 is not going to be as awesome as we had all hoped, but it's got a lot of inherent demand and a lot of potential for those builders who are willing to put in the work now and continue to prepare to execute in 2026. So look, somebody once told me, how do you get successful in an industry? They said, you look at the top performers and you emulate the things that they do. You don't have to copy them, but you emulate. You don't always have to reinvent the wheel. I tell people, it's like, you know what? Creation is easier than implementation. So if you look at what somebody else is doing and you emulate it and you can implement it, That is a bigger win and a bigger kudos, a bigger feather in your cap, in my opinion, than creating some great grand scheme that may or may not ever get implemented. Okay? So let's keep learning from the best. Keep building smarter. Thanks again for joining us on this episode of The Builder's Mindset. We'll talk to you next week. Have an amazing day. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.